All right, today we are going to dive deep and break down a very specific structured plan for accumulating Litecoin. This comes straight from our source material, and it's not just theory. It's a step-by-step method that tries to tackle one of the biggest challenges in crypto.
And yeah, you know what that challenge is. It's the volatility. I mean, how do you even begin to make a rational plan for a market that can have these insane swings, sometimes in a single day? It's the question every single one of us has to deal with.
So, the source we're looking at today? It offers one possible answer. It's a methodical two-sided plan, one for buying Litecoin and one for taking your profits. So let's get into it and see exactly how it's supposed to work.
Okay, so at the very heart of this whole thing is a classic investment idea. Dollar cost averaging, or DCA for short. Now, instead of trying to perfectly time the bottom and throwing all your money in at once, which, let's be honest, is pretty much impossible, you break your investment up. You buy in smaller chunks over time. By doing that, you smooth out your average cost, and maybe more importantly, you take a lot of the stress out of trying to make that one perfect trade.
So let's start with the first half of this strategy, the buy plan. This is all about the accumulation phase. The goal here isn't to buy all your Litecoin at once, but to scoop it up at several different price levels that you've already decided on ahead of time.
The approach here is a three-tiered system. You can kind of think of these as setting three different safety nets, one below the other, ready to catch the price if it starts to fall. It's a really deliberate, patient way to buy that removes a ton of the emotional guesswork.
The whole strategy kicks off with this first entry point, right at $80.28. Now, the source material mentions this was about 5% below the market price when it was written, so this is your starting block.
But what if the price keeps dropping? Well, that's exactly what the second net is for. The second buy order is sitting there waiting at $68.24, which is about 15% lower than the first one. This is DCA in action. You're actually buying more as the price gets cheaper.
And then we have the final backstop, the last buy level, set at $58 even. That's another 15% drop from that second tier. Now, if the market dips enough to trigger all three of these orders, your average cost is going to be way lower than that initial $80 entry, putting you in a much stronger position. Okay, so that's the game plan for getting in. But a strategy is only half done if you don't have a clear plan for getting out. Seriously, an entry strategy without an exit strategy isn't a strategy at all. It's just a gamble. So let's flip the script and look at the take profit side of this thing.
Now, what's really cool here is how clear and simple this is. The whole framework says that all your profit targets are calculated from that very first buy-in price of $80.28. This gives you a really stable, consistent baseline to work from, no matter what your final average buy-in price ends up being.
And just like the buying plan, the selling side is also broken down into three systematic tiers. The psychological advantage of this is huge, you know? It helps you avoid that greed that kicks in when you're trying to sell at the absolute tippy top of the market. Instead, you're just methodically locking in your gains as the price goes up. The first take-profit target is set right here at $96.34. This works out to be about a 20% gain over that base purchase price. This is your first stop to start cashing in some of those profits. Now, if the price keeps climbing, your second sell target gets hit at $115.61. That's another 20% jump up, continuing that laddered exit approach. And the third and final take profit level in this specific plan is $138.73. This is the highest planned exit, designed to lock in that last chunk of your gains according to the structure you already set up. All right, that was a lot of numbers, I know. We've walked through the buy side, and we've walked through the sell side. So let's pull it all together now and look at the entire strategy at a glance. And boom, here it is. This just lays out the whole mechanic perfectly. On the left, you've got your three accumulation levels. They're designed to lower your average cost if there's a dip. And on the right, you've got your three profit-taking levels, designed to systematically lock in your gains when things are going up. It's a clear, two-sided roadmap. It's built to manage both the opportunity and the risk. Okay, now before we wrap this up, there's a really vital section in the source material about risk and management. A plan is only as good as your understanding of the dangers involved, so this part is absolutely crucial. You have to pay attention here. The source says this, plain and simple. This isn't buried in the fine print. It's the fundamental truth that this entire strategy is built around. That volatility is exactly what the DCA plan is trying to help you navigate, but it also means there are absolutely no guarantees of success. None. And that reality leads to these key rules to live by.
First, this is for the long term, not for day trading. It means you have to be actively watching the market, ready to adjust your orders if things change. And critically, and I can't stress this enough, you have to manage how much risk you're taking on and never ever over-leverage yourself. The big takeaway is this is not a set it and forget it kind of deal. It takes discipline and your active attention.
And that really leaves us with a final thought to chew on. A detailed strategy like this one, it doesn't get rid of risk. It doesn't conquer the market. But what it does do is offer a structured way to navigate the crazy ups and downs with a much cooler head. It's like having a map for a very bumpy journey, and just having that map can be an incredibly powerful tool.